Welcome to Forex Central. We're thrilled to have you join our YouTube, Facebook and Telegram channel dedicated to all things Forex. Here, you'll find a community of passionate traders, investors, and enthusiasts who share a common goal of achieving financial success through the exciting world of foreign exchange. Stay tuned for regular updates, trading tips, market insights, and educational content that will empower you to make informed decisions and navigate the Forex market with confidence. We believe in the power of knowledge and collaboration, so feel free to engage with fellow members, ask questions, and share your experiences. At Forex Central, we're committed to creating a supportive and inclusive environment where everyone can learn, grow, and thrive. Our channel is designed to be a hub of valuable information, resources, and opportunities that can help you unlock your trading potential. Thank you for being a part of Forex Central. Get ready to explore, connect, and embark on an exciting journey towards financial freedom. Happy trading! Forex Central Weekly Gold Analysis for July 24 to 28, 2023, preparable scenario is a sell entry at 1,963.69, sell stop loss at 1,972.74, sell take profit 1 at 1956, sell take profit at 1944. For gold support and resistance analysis, support 1 at 1957 to 1956, support 2 at 1945, resistance at 1972 to 1969. For gold trend analysis, for long term, it's downtrend, for short term, it's downtrend. For weekly gold analysis, Forex Central preparable scenario is a sell entry at 1,963.69, sell stop loss at 1,972.74, sell take profit 1 at 1956, sell take profit at 1944. On July 24, Monday, the Flash Manufacturing Purchasing Managers Index (PMI) will be released. The Flash Manufacturing Purchasing Managers Index (PMI) is an economic indicator that provides a preliminary snapshot of the manufacturing sector's health in a particular country. It is released ahead of the final PMI figures and is based on survey data collected from purchasing managers in the manufacturing industry. The impact of the Flash Manufacturing PMI on the market can be significant, as it provides traders and investors with early insights into the current economic conditions in the manufacturing sector. Here are some ways the Flash Manufacturing PMI can impact the market. 1. Market sentiment. The Flash Manufacturing PMI can influence market sentiment, as it offers an early indication of economic activity. A higher than expected reading may boost confidence in the economy, leading to positive sentiment and potentially higher stock market prices. 2. Currency movements. Forex traders closely watch the Flash Manufacturing PMI, as it can affect the value of a country's currency. A stronger than expected PMI reading may lead to an increase in the country's currency value, while a weaker reading may cause depreciation. 3. Interest rates. Central banks often monitor economic indicators like the Flash Manufacturing PMI when making decisions about monetary policy. A robust manufacturing sector may signal economic growth, potentially leading to higher interest rates to control inflation. 4. Industry stocks. The PMI data can impact specific industries, particularly manufacturing-related sectors. Strong PMI figures may lead to increased demand for stocks of manufacturing companies, while weak PMI figures may negatively affect their stock prices. 5. Commodities. The manufacturing sector's health can also influence demand for commodities used in industrial production. Positive PMI data may increase demand for raw materials, potentially boosting commodity prices. 6. Overall economic outlook. The Flash Manufacturing PMI is a component of broader economic indicators. A strong manufacturing sector can contribute to a positive outlook for the overall economy, while a weakening sector may raise concerns about economic growth. It's important to note that the Flash Manufacturing PMI is a preliminary figure and is subject to revision when the final PMI data is released. Traders and investors should consider other economic indicators, market conditions, and geopolitical factors when interpreting and responding to PMI data. On July 25, Tuesday, the Consumer Confidence Index (CCI) will be released. The Consumer Confidence Index CCI is an economic indicator that measures consumers' optimism or pessimism about the state of the economy. It is based on survey data collected from a representative sample of households and reflects consumers' perceptions of current economic conditions and their expectations for the future. The impact of the CB consumer confidence on the market can be significant, as consumer spending is a crucial driver of economic growth. Here are some ways the Consumer Confidence Index can impact the market. 1. Stock market. Positive consumer confidence data indicating increased optimism among consumers may lead to higher stock market prices. When consumers feel confident about the economy, they are more likely to spend, which can benefit companies and potentially boost corporate earnings. 2. Currency movements. The CCI can influence the value of a country's currency in the forex market. A higher consumer confidence index may lead to an appreciation of the currency, as it signals economic optimism and potential interest rate hikes by the central bank. 3. Interest rates. Central banks often consider consumer confidence data when making decisions about monetary policy. High consumer confidence may signal strong economic growth, potentially leading to higher interest rates to control inflation. 4. Retail and consumer sector. The Consumer Confidence Index can impact specific industries, particularly those directly linked to consumer spending. Positive consumer sentiment may lead to increased demand for retail and consumer goods, potentially benefiting related companies' stocks. 5. Economic outlook. The CCIA is considered a leading indicator of economic health. A rise in consumer confidence may suggest that consumers are optimistic about future economic prospects, which could lead to an improved overall economic outlook. 6. Consumer behavior. Consumer confidence influences spending patterns. High consumer confidence may lead to increased consumer spending, boosting economic activity, while low confidence may result in reduced spending, impacting economic growth. It's important to note that the Consumer Confidence Index is just one of many economic indicators that impact the market. Traders and investors should consider other factors, such as employment data, GDP growth, inflation rates, and geopolitical developments to gain a comprehensive understanding of the economic environment and make informed investment decisions. On July 26, Wednesday, new home sales will be released. New home sales is an important economic indicator that measures the number of newly constructed homes sold during a given period. It provides valuable insights into the housing market's health, which is a crucial sector in most economies. The impact of new home sales on the market can be significant, and here are some ways it can influence various aspects. 1. Housing market sentiment. New home sales data reflects the level of demand for newly constructed homes, which can indicate consumer confidence in the housing market. Higher than expected new home sales figures may boost sentiment and indicate a robust housing market. 2. Construction and real estate sector. New home sales directly affect the construction and real estate industries. Strong sales may lead to increased construction activity and positively impact related companies' stocks and the overall sector. 3. Economic growth. Housing is a major contributor to economic growth. Increased new home sales signal consumer spending and investment, contributing to overall economic expansion. 4. Interest rates. Central banks often monitor housing market data, including new home sales, when considering monetary policy decisions. A thriving housing market may influence central banks' decisions on interest rates and other monetary measures. 5. Consumer spending. The purchase of a new home is a significant financial decision. New home sales data can impact consumer spending patterns, as it reflects the confidence of homebuyers in the economy and their financial situation. 6. Currency movements. Strong new home sales data may lead to an appreciation of the country's currency, as it indicates economic strength and potential interest rate hikes by the central bank. 7. Housing affordability. New home sales data can provide insights into the affordability of housing for the general population. If new home sales are slowing down, it may signal challenges in the housing market and potential affordability issues. 8. Market sentiment. Positive new home sales data can boost investor confidence and market sentiment. Conversely, weak data may lead to cautious investor behavior. It's important to remember that new home sales is just one of many economic indicators that impact the market. Traders and investors should consider other economic data, geopolitical developments, and overall market conditions to make informed investment decisions. On July 27, Thursday, the Advanced Gross Domestic Product (GDP) QQ and unemployment claims will be released. The Advanced Gross Domestic Product (GDP) QQ and unemployment claims are two important economic indicators that can have significant impacts on the financial markets. 1. Advanced GDP QQ. The Advanced GDP QQ is a key indicator that measures the annualized change in the inflation-adjusted value of all goods and services produced by a country's economy during a specific quarter. It provides an early estimate of economic growth and is closely monitored by investors and policymakers. Impact on the market. Stock market. Positive GDP growth can boost investor confidence, leading to higher stock market prices. It signals a healthy and expanding economy, which can benefit corporate earnings and stock valuations. Currency movements. A higher than expected GDP growth rate can strengthen the country's currency, as it reflects economic strength and potential interest rate hikes by the central bank. Interest rates. Central banks often consider GDP data when making decisions about monetary policy. High GDP growth may lead to higher interest rates to control inflation. Bond market. Positive GDP growth can lead to higher bond yields, as investors may anticipate a tightening monetary policy by the central bank. 2. Unemployment claims. Unemployment claims provide a weekly count of the number of individuals filing for unemployment benefits due to job losses. It serves as an early indicator of the labor market's health and economic conditions. Impact on the market. Stock market. Higher than expected unemployment claims can lead to a negative market reaction, as it indicates potential weakness in the labor market and economic uncertainty. Currency movements. An increase in unemployment claims may weaken the country's currency, as it raises concerns about the economic outlook and potential monetary policy response. Interest rates. High unemployment claims may influence central banks to maintain accommodative monetary policies to support economic recovery and job creation. Consumer sentiment. Rising unemployment claims can negatively impact consumer sentiment, leading to reduced consumer spending and affecting retail and consumer-related stocks. It's essential to note that these economic indicators are just one part of the larger economic landscape, and market reactions can be influenced by various factors, including other economic data releases, geopolitical events, and overall market sentiment. Traders and investors should consider a comprehensive view of the economy and market conditions to make well-informed decisions. July 28, Friday, the Core Personal Consumption Expenditures Price Index, Core PCE Price Index, (M/M), and the Employment Cost Index, ECI-QQ, will be released. The Core Personal Consumption Expenditures Price Index, Core PCE Price Index, (M/M), and the Employment Cost Index, ECI-QQ, are two important economic indicators that can have significant impacts on the financial markets. 1. Core PCE Price Index (M/M). The Core PCE Price Index is a key measure of inflation in the United States, focusing on the price changes of consumer goods and services, excluding volatile food and energy components. The M/M, month-over-month, figure indicates the percentage change in prices from the previous month. Impact on the market. Interest rates. The Federal Reserve closely monitors inflation indicators, including the Core PCE Price Index, when making decisions about monetary policy. Higher than expected inflation may lead the central bank to consider raising interest rates to control inflation. Currency movements. Rising inflation, as indicated by a higher Core PCE Price Index (M/M), may lead to an appreciation of the country's currency, as it signals potential interest rate hikes by the central bank. Bond market. Higher inflation expectations can lead to higher bond yields, as investors may demand higher yields to compensate for the eroding purchasing power of fixed income payments. 2. Employment Cost Index (QQ). The Employment Cost Index measures the change in the cost of labor for businesses. It includes wages, salaries, and benefits, and it provides insights into labor market conditions and wage inflation. Impact on the market. Interest rates. The Federal Reserve considers labor market conditions when formulating monetary policy. A significant increase in the Employment Cost Index may lead to expectations of higher inflation and interest rates. Stock market. A higher than expected employment cost index may lead to concerns about rising labor costs for businesses, potentially impacting corporate earnings and stock market sentiment. Consumer spending. The employment cost index can influence consumer spending patterns. Rising labor costs may result in higher prices for goods and services, affecting consumer purchasing power and spending behavior. It's important to note that these economic indicators are just two components of the broader economic landscape, and market reactions can be influenced by various factors, including other economic data releases, geopolitical events, and overall market sentiment. Traders and investors should consider a comprehensive view of the economy and market conditions to make well-informed decisions.